Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market Review, July 22nd. Macro, short squeezes, and Q2 earnings.
This video presents a direct informational narration of the source document. So let's jump right into the macro pressures we're looking at today. The market drop on July 22nd didn't just happen in a vacuum. It was directly tied to the turbulence in the Middle East. Specifically, we're talking about a U.S. missile strike on Iran's Karg Island. Now, as you might expect, this caused international oil prices to rise, which naturally drives up inflation expectations. And when that happens, it really boxes in the monetary policy for central banks globally. On top of that, if you've been watching the 10-year Treasury yield, you'll see it's just continuing to climb, and that is actively putting a damper on the market's overall risk appetite. And the plot thickens when we look over at Japan. The Japanese yen has actually plunged below the 163 mark. To put that into perspective, that is a 40-year low. It's gotten so extreme that the Japanese finance minister had to step in with a rare warning, saying they might take bold action. Because of this persistent weakness in the yen and all the risks attached to it, the broader market is now expecting the Bank of Japan to hold rates steady at their July 31st meeting, but then follow that up with a rate hike in December. All right, let's shift our focus over to the broader U.S. market, where things are getting pretty wild. Short interest in the S&P 500 constituents has just hit 3.79% of free float. That is literally the highest level recorded since way back in 2010. And it's not just the S&P. Short interest in the Russell 3000 has also hit a record high, sitting at 6.3%. Now, what does this actually mean for us? Well, the source document theorizes that this massive short positioning acts almost like mechanical buying support. You see, the market makers who are selling these hedges are basically forced to continuously inject buying power into the market. It creates this really fascinating yet super fragile equilibrium. The data tells us that long positions are roughly double the size of these short bets. So if that long momentum starts to weaken, or if the shorts accumulate even more, this whole delicate balance could absolutely shatter at any moment. You're probably wondering, where exactly are all these shorts concentrating? Well, aggressive short sellers have essentially put a bullseye on the AI and semiconductor sectors. They are going right after the giants, the Magnificent Seven, Micron, and Broadcom. And it's having a real impact. Because of this, the U.S. tech momentum factor has actually pulled back a massive 40% from its peak. It just goes to show you the sheer force these short positions are exerting on sectors that were recently flying incredibly high. Let's zoom in on a highly targeted specific case. SpaceX. The short interest here has absolutely exploded. We're talking a jump from $4.5 billion back on June 15th to a staggering $25 billion right now. That represents a full 32% of the float. This creates an incredibly critical time window, especially since their first ever post-listing quarterly earnings report is coming right up on August 4th. But wait, there's more. Just 2 days after that earnings report drops, SpaceX is facing a massive lockup expiry. We are looking at 920 million insider shares on locking, which carries a value of roughly $116 billion. By the time we hit year-end, the total tradable float is projected to increase exponentially, jumping from 639 million shares up to 5.33 billion shares. It's a huge shift. Elon Musk actually came out and warned the short sellers that their probability of survival is low, but ironically, that warning sent the stock tumbling below its 5-day moving average as algorithmic selling pressure totally took over. So how do we value all of this? Breaking down the valuation scenarios, if we look at a merged valuation with XAIA, it sits at $1.2 trillion. If we're talking about a reasonable fair value range, it's estimated between $1.1 trillion and $1.25 trillion. Now, in a bear case scenario, or an extreme sell-off environment, that valuation could drop to somewhere between $800 billion and $1 trillion. And the absolute floor? Based on Morgan Stanley's cash flow calculations, it's pegged at just $63. But it's crucial to remember that any valuation here has to account for the Musk premium. Right now, retail investors are largely buying into the individual himself rather than just looking at traditional financial metrics. Next up on the radar is Rocket Lab. They just secured a massive $266 million U.S. government contract for 12 launches, and that includes options for 6 more. Despite that great news, the stock still got dragged down. Why? Because the broader space sector experienced a huge pullback, which was heavily initiated by those immense pressures we just saw on SpaceX. Zooming back out to broader tech trends, the source notes a very strong conviction in AI hardware right now. This confidence isn't just hope. It's backed by real, tangible orders and high earnings visibility. On the flip side, things look pretty grim for the software sector. That space is struggling heavily with delayed enterprise spending and a really noticeable lack of mass commercial AI applications. To give you some solid proof on the software side, let's take a look at the Q2 earnings for UiPath and IBM. UiPath saw a 24% revenue increase and 9.8% EPS growth. Now, that might sound okay, but it completely lacks the high growth attributes it used to have. Meanwhile, IBM reported a really meager 1% year-over-year revenue increase, with their adjusted EPS coming in at $2.93. The source views these results as direct evidence that enterprise budgets are actively shifting away from software. Turning our attention to Tesla's Q2 earnings profile, the numbers show $28.2 billion in revenue, which is a solid 26% year-over-year increase. However, their adjusted EPS missed expectations, landing at just 33 cents, and their free cash flow? It actually turned negative, dropping by $1.1 billion purely due to massive capital expenditures. But here's the interesting part. Despite these metrics, the real market anticipation isn't just about immediate vehicle delivery numbers. It's actually centered around potential narratives or even a possible merger involving SpaceX. Okay, let's examine Google's Q2 results. The company posted $119.8 billion in revenue, which is up 24% year-over-year. A huge takeaway here is that capital expenditures nearly doubled, reaching $4.49 billion. EPS came in at $9.11, but it's worth noting that free cash flow dropped to a negative $5.9 billion. This naturally caused some investor hesitation, even though Google is sitting on a massive cash reserve of $242.5 billion. But the most crucial data point in Google's entire report is their cloud revenue growth, which hit a really impressive 28%. The source concludes that this essentially proves the AI investment cycle is actively accelerating right now. So while that massive capital expenditure we just talked about is definitely bearish for Google's short-term cash flow, it is a highly bullish signal for the entire AI semiconductor supply chain. Looking over at Texas Instruments, their Q2 results showed $5.46 billion in revenue and $980 million in net income. They actually beat estimates, but the catch? The results were entirely expected by the market. Because there was no major surprise, the stock actually fell. It just goes to show how incredibly unforgiving this particular earnings season is. On a slightly different note, let's look at the power equipment giant GE Vernova. They posted some really strong Q2 numbers. Revenue grew 22% year-over-year, and they brought in a record $2.4 billion in orders, with an EPS of $2.47. They were even confident enough to massively raise their free cash flow target to somewhere between $11.5 billion and $12.5 billion. However, this incredible overall performance is heavily contrasted against the ongoing losses they're still seeing in their wind business. Finally, AMD remains incredibly resilient, hovering near record highs after signing a major $5 billion investment agreement, where a partner will purchase 2 gigawatts worth of chips.